Very good evening, all of you. Please confirm if my audio, video, and the screen is visible properly and clear to all of you. Please confirm, guys. Fair enough. So in the last class we discussed certain chapters, and in the today's class we'll be discussing revenue, we'll be discussing taxes, and we'll be discussing provisions, we'll be discussing government grants, and we'll be discussing the events occurring after the reporting date. So these are the 5 topics which we'll be discussing in the today's session. Okay, now if you have noticed, we are going in the order of the level of importance of the chapters, right? So we are following that order. So when you are revising at your own, so you have to, I'll recommend you to follow this order. Okay, because this I'm discussing the chapters in the level of their complexity also, in the level of their importance for an exam perspective also, right? Yes, definitely group accounting forms is the most important topic, but yes, since it's a very big topic, I'll take it at the on the day 4, not now. Okay, now okay, so starting with topic 1, that is revenue. Guys, we understand that revenue recognition is derived by 5 steps, right? Which is also called as 5-step model, and the 5-step goes like this. 5-step goes like this: that identify whether there is a contract or not. Second, once you have identified whether the contract exists or not, identify what is your performance obligations in the contract. Okay. Now, third, you have to identify that overall for all the performance obligations in the contract, for all the performance obligations, what is the meaning of performance obligation? What is the responsibility in the contract, right? What is the responsibility in the contract? Now, once you have determined what is the responsibility in the contract, for overall responsibilities, what is the price that a customer will pay? What a price that a customer will pay, which is also called as transaction price. Okay. Now, once you have determined that for overall contract level, this is my performance obligations. For overall performance obligations, this is the transaction price. Now, as part of step number 4, you have to allocate the transaction price to each of the performance obligations. Let's suppose in a contract there are 3 performance obligations, and in step 3 we have determined the transaction price. Now in step number 4, what we have to do is this transaction price we have to break into small parts for each performance obligations. We have to basically allocate it. Now step number 5, as and when these performance obligations get satisfied, recognize revenue for that. Now speaking from an exam perspective, step number 1 and step number 2 are not that relevant, though I cannot say that they are not important, but they are not that relevant as compared to step 3, 4 and 5. Okay, so I'll not be putting much emphasis on these 2 steps. Okay, but just what I'll do is I'll quickly discuss this and move ahead to step 3, 4 and 5. Now, how to identify whether contract exists or not? There are 5 conditions which we have discussed in the class also. What are the 5 conditions? That it has to be approved by both the parties. Then what next? Tell me. Rights and obligations of both the parties should be clear. Third, payment terms should be clear. Plus there should be a commercial substance. What is the meaning of commercial substance? That this transaction has been entered into with an intent of earning the profit, right? Commercial substance. Plus the amount is probable to be recovered. If these 5 conditions exist, we can say there is a contract. Otherwise there is no contract. Okay, now this is step number 1. Now coming to step number 2, identify performance obligations. Now how will you identify performance obligations? Basically you have to remember that each performance obligations should be distinct. Now distinct in 2 respects: on its own and in relation to other promises in the contract. How it will be distinct? How will we say whether it is distinct or not? whether the seller can sell it separately or not, and whether the customer can use it separately or not. If both these conditions are being satisfied, I can say that the performance obligations are distinct on its own and in relation to other promises in the contract. Is that clear, guys? So we have discussed step number 1 and step number 2 in quickly. Okay, now let us move on to step number 3, 4 and 5, and we'll discuss each of them much in detail, whatever is required for your exam preparation. Okay, now coming to step number 3, that is determine the transaction price. See guys, I told that for transaction price what you have to understand, that transaction price is generally the is also called as, you can say, contract price, is also called as contract price, right? Now the question comes up, if the contract price is variable, will we include that in the transaction price? Will we include that in transaction price? So standard says yes, you can include that in transaction price. You can include, the standard says yes, but only if these variable consideration will not be reversed in future, will not be reversed in future. Meaning thereby, see what happens, what is the meaning of variable consideration? The consideration, whether this will be paid or not, is dependent upon some future conditions, right? So it says that when that future conditions which is uncertain now will be resolved in the future, when that future condition will be resolved, you will not reverse this variable consideration. Basically, when you are certain, when you have a probability, high probability that yes, you will be able to satisfy the future condition, it is then only recognize variable consideration as a transaction price, otherwise do not recognize. Why? Because if you recognize variable consideration as a transaction price, you will allocate it to performance obligations, and once you allocate to performance obligations, you might recognize as a revenue now. So if you recognize something as a revenue now, you will not want to reverse it, right, in the future. So that's why it says that whenever you are recognizing variable consideration as a transaction price, recognize only if you are certain, reasonably certain. Otherwise, do not recognize it. If you are not certain, do not recognize it. Okay. Now coming to significant financing component. Guys, this is a very important topic from an exam perspective. Let's understand how to do this one, how to solve this question. First, let's understand what is the meaning of significant financing component. Guys, many times we see that the entity has performed the goods, performed the services now, but will receive the amount after 1 year or after 2 years. Or entity has delivered the goods or services now, but will receive the amount after 1 year or after 2 years. Right? Let's suppose we purchase products on EMI. Think from the point of view of entity. Entity has delivered the goods now itself, right? But it will receive the price maybe after a year or so, right? So in that case, how will that company recognize, or how will that entity recognize a revenue? So it says that step 1, it says that determine contractual cash flow. Step number 2 is calculate present value of contractual cash flow, and this present value is called as revenue. This present value of contractual cash flow is called as revenue. Now how will this work? First, there should be a time gap greater than 12 months. Between what? Between satisfaction of performance obligation, and what? And receipt of money. or you can say in the bracket transaction price, right? Now, so how will you determine revenue? Is the determine contractual cash flow, basically what you are paying under the contract, what the customer is paying under the contract, what the customer is paying under the contract, and then you calculate the present value of that. That is your revenue. That is your revenue. Let me give an example for that. Let me take up an example for that, so that the things become more clear. Let's suppose an entity sells a laptop here. An entity sells a laptop here, okay, and will receive the money after 2 years. That is dollar 15,000 will be received here by the entity. Okay. Now, then what is the revenue here? What is the revenue to be recognized? Let's suppose the discounting rate which will be given in the question is 10%. So what is the revenue to be recognized? The present value of 15,000 at the rate of 10%, that is 1 to 400, 12,400 is the amount of revenue that is to be recognized. Now you must be wondering how will we recognize the differential? Guys, we must understand that the differential will be recognized as the finance income. How the journal entry will flow? So it will flow like this. It will flow like this. Here it will be recorded as trade receivables account debit to revenue. How much? 12,400. 12,400. At the year end, when you will unwind this, how will you record? How will you record it? So you will pass entry trade receivables account debit to finance income. How? 12,400 multiplied by 10% is 1240. 1240. Now what is the balance becomes of trade receivables? Trade receivable balance becomes how much? 12,400 plus 1240 is 13640. Right? Now again same entry will be passed here, but the amount will be 1364. Amount will be 1364. Now what is the amount of trade receivables on this date? Trade receivables become how much? Plus 1364 is 15,004. This $4 is coming on account of rounding of error. And what is the entry that will pass here then? In that case, the entry that will pass here will be bank account debit to trade receivables 15,000. So this is how it will be treated for. Right? So this is how it will be structured. So you must understand your revenue is not 15,000, but your revenue is only 12,400. The rest is your finance income. Is that clear, guys? Is that clear to all? Is that clear to all? Is that clear to all? The significant financing component. Okay, fair enough. Now let's move on to the next concept, that is non-cash consideration. What is the meaning of non-cash consideration? Let's suppose this is an entity, and this is the customer. Entity sold a laptop to the customer, and the entity received the consideration not in cash. The consideration is not received in cash, but is received in non-cash. The question is, how will the entity recognize revenue in that case, right? So the fair value of the non-cash consideration will be equals to your transaction price. The fair value of the non-cash consideration that you have received is your transaction price. Is that clear, guys? Is that clear to all? So many times students make mistakes that what is the ideally what is the selling price of this laptop, that will be the revenue. No, that should not be the revenue. The price that you have received is your revenue. If you have received in cash, it's fine. If you have not received in cash, you have received in something else, then fair value it. What is the fair value of that of the non-cash item that you have received? And that is your revenue. Definitely, if this cannot be found out, then we will take the fair value of the asset given up. Is that clear, guys? So a student generally make a mistake in the exam, which is mentioned in the examiner report as well, that a student takes the fair value of the laptop as the transaction price, and you don't need to do that mistake. Okay. Now, consideration payable to customer. Okay. This topic is a topic where the mistake is made the most, though we don't have much questions on this topic, consideration payable to the customer, though we don't have the much questions on this topic, but still this is a very good concept. Let's discuss that. Entity, customer, entity and customer. It says that entity had definitely supplied, let's suppose, laptop to the customer. Entity has sold laptop to the customer. Then ideally entity should receive the money from the customer, right? But in this case, what is happening? See, consideration is payable to the customer itself. Entity is paying a consideration to the customer. Why? So standard says that there can be two aspects for that. What are the two reasons? What are the two reasons for that which the standard mentions? Reason one is customer has supplied certain goods to entity. Customer has supplied certain goods to the entity for which the consideration is being paid by the entity to the customer. And if that is the case, you have to treat it as a separate transaction. The sale of laptop and the consideration for that, and the transfer of goods by the customer to entity, and the consideration paid by entity to the customer. Treat these as two separate transactions. Another thing, if these goods are not there, then what you have to do? You have to reduce this consideration from transaction price. Is that clear, guys? Basically, let's suppose if I am an entity and you are supposed to pay me fees, let's suppose you have supposed to pay me a fees of rupees 15,000, and I am paying you 1,500 back, sort of a cashback, right? So what is the transaction price? 15,000 minus 1,500 is 13,500, right? So that is the transaction price. Is that clear, everyone? The consideration payable to the customer. Come on, guys, please confirm if it is clear, or if you have any queries, please definitely ask your queries. Okay, fair enough. Now coming on to point number 3, that is allocating transaction price to each of the performance obligations. So for that, what the standard says that you have to allocate the transaction price to each of the performance obligation in ratio of their standalone selling price. What is the meaning of this? Let me take up an example for that. Let's suppose there is a performance obligation number 1, performance obligation number 2, okay, and both of them are being sold at a price of rupees 100. Let's suppose at a price of $100. Let's suppose the both of them are sold at a price of $100. So this becomes my transaction price. This becomes my transaction price. But individually, performance obligation number 1 is sold at a price of 70 and at a price of 50 and at a price of 50, right? So the question that comes up is, how will you allocate this $100 to performance obligation number 1 and to performance obligation number 2? In the answer is in the ratio of 70:50. This basically, how is performance obligation number 1 sold standalone in the market? If I am selling performance obligation number 1 solely, at what price I'll sell it? So the price is $70. If I sell performance obligation number 2 solely in the market, I'll sell it at $50. I'll sell it at $50, right? So what is the allocation? So the allocation will be 100 into 70 by 120, and here the allocation will be 100 into 50 by 120. So what is the allocation that comes up? That is 100 multiplied by 70 divided by 120 is 58.33, and here the allocation comes up 100 into 50 divided by 120, that is 41.67. That is 41.67. So this is how the performance, this is how the transaction price has to be allocated to each of the performance obligations. To each of the performance obligations. Is that clear to all? Is that clear to all? Now, coming on to the fourth point. Very good, Manav. Very good, Akshit. Okay. Now, you have to recognize this is as part of step number 5. This is as part of step number 5. As part of step number 5. Now, the question is, when is say it says that step number 5 says that as and when your performance obligation is being met, recognize revenue for that. Let's suppose there are two performance obligation number 1 and performance obligation number 2. You satisfied performance obligation number 1, recognize revenue for that. You don't need to wait for performance obligation number 2, right? If you satisfy 1, recognize revenue for that 2. Okay, if you satisfy 2, recognize revenue for that. Okay, so as and when you satisfy your performance obligations, keep on recognizing revenue for that. But the question that comes up is, when is performance obligation deemed to be satisfied? Akshit has a question. If it is not mentioned in the question, whether to answer in 2 decimal places or whole number, how should we answer it? Guys, see, if it is not mentioned in 2 decimal places, round it off. Okay, round it to the nearest decimal. Okay, so basically in this case it could become 58 and 42. It will become 58 and 42. And also I'll give you the guidance at the end of the today's session. Just remind me at the end of today's session. I'll give you certain guidelines for answering the questions in the class. Okay, in the exam. Okay. Now coming back to our topic, that is, when is performance obligation met? See, performance obligation is met when the control is transferred. When the control is transferred. Let's suppose entity has a laptop. Okay, when is laptop deemed to be transferred? When the control of the laptop transfers from the entity to the customer, right? When the control transfers. Now, when is control deemed to be transferred? So control is transferred. Standard says control is transferred at a point in time, or at a over time, or over a period of time, at a point in time or over a period of time. So our standard and our BPP material also prescribes us 3 conditions for that. Harpreet, it's not the risk and reward, it's the control. It's the control that is important. Okay, it's the control that is important. Now, Risk and rewards we used to discuss from an accounting standard perspective, not from an IFRS perspective. Okay. Now, okay. How to assess whether the control is transferred at a point in time or over a period of time? First, let's understand the meaning of point in time or over a period of time. Let's suppose when I sell this pen, when is control transferred? At specifically at this point, right? Now, let's suppose if I take classes for your ACCA financial reporting, the classes goes on for 3 months. When is the control transferred? The control is being transferred over a period of 3 months, right? Control is being transferred over a period of 3 months. So how will we understand or analyze whether the control is transferred at a specific point in time or the control is transferred over a period of time? Okay, so standard gives us 3 conditions and it says that even if any one condition gets satisfied, it should be over a period of time, otherwise it should be point in time. Okay, now what are 3 conditions? What are the 3 conditions? Can anyone tell me the 3 conditions? Can anyone tell me 3 conditions one by one? What are the 3 conditions? Come on, guys. What are the 3 conditions? Okay, let me answer it. I don't think so any of you have revised your syllabus before coming to the class. As soon as benefit is received, no. Customer receives and consumes benefit and consumes benefit as entity performs. Very good, Vidisha. Very good, Vidisha. As entity performs okay. Second condition, tell me. Customer controls asset. Rajat, your answer is not complete. Entity's performance creates and enhances the asset that customer controls. And third is entity has right to payment and plus no alternative use for the asset. Now let me analyze these 3 conditions. Though in the exam they will never ask you to analyze these 3 conditions, they will never ask, but yes, this is very much important. This is very much important. Okay, let me take up 2 examples and analyze the situation. Okay, 2 examples. Example number 1. Example number 2. Okay, example number 2 is our teaching services, that the services which I perform. Example number 1 is sale of goods. Now, or there is no performance here, right? I'll take up another example. Construction of flat by builder. Okay, let me take up two examples. Okay, let's suppose you as a customer have paid the advance booking amount for purchasing any flat. Okay, now tell me, as the entity performs, as the entity starts constructing the construction of the building, and you are a customer, will you receive any benefit? Will you receive any benefit? No, you will not receive any benefit. Okay, now as the entity is constructing the building, are you controlling that building, or something is getting enhanced for you specifically? Tell me. No. Now let's suppose you gave an advance booking, you gave an amount for advance. Okay, and the work is done, 70% work is done. Okay, and then you want to exit from that contract. Okay, though the advance booking amount that you have paid is not refundable, will not be refundable, but yes, tell me, are you eligible to pay him the amount till 70%? No, you are not eligible. You are not required to pay, right? You are cancelling the contract. You are not required to pay. Whatever you have paid will definitely not be refunded. But yes, you are not required to pay anything extra. You are not required to pay anything extra, right? Not required to pay anything extra, right? So what happens? Neither this condition gets satisfied, nor this one, right? Not this one. None of the conditions are getting satisfied. So what happens here? So this is a point in time, meaning thereby when the keys of the flat are handed over to the customer, it is deemed as that the control is transferred at that point. When the keys of the flat are handed over to the customer, it is deemed that the control is transferred. Okay. Now let's talk about our teaching services. Okay, our teaching services continue for 3 months, right? When I am teaching you, you receive the benefit as I am teaching, right? Tell me. You receive the benefit as I am teaching. So as I am performing, you are receiving the benefit, right? Side by side, alongside. Tell me yes or no. Customer, you as a customer, you are receiving and consuming the benefit as I am performing. Tell me yes or no. So for example number 2, condition number 1 gets satisfied. Condition number 2, entity's performance creates or enhances the asset that the customer controls. So there is no asset in our case, so not get satisfied. Okay, entity has right to payment. Let's suppose if we in our classes, if I completed 70% of our syllabus, and now you don't want to continue with my classes, don't you think you have to pay me at least to the extent of 70%? Right? So I am at least eligible for 70% of the classes, right? Fees for the 70% of the classes, right? So that's what, again, entity has a right to payment. So this is also satisfied. So what I said at the start, if any one of these conditions are satisfied, if any one, then we can say we have to recognize revenue over a period of time. Otherwise it is point in time. So the fees that you pay to me, I will recognize it as a revenue not on the date when you are paying it to me. I will recognize it as a revenue as and when I perform my services towards you, right? As and when I perform my services towards you. Are you understanding it, guys? Are you understanding it? Okay, fair enough. Now, see, we need to understand that if the revenue has to be recognized over a period of time, there should be some measure. To assess that how much percentage work is completed, right? How much percentage work is completed? There should be some measure to do that, right? Because basically, let's suppose if I say that I will recognize my revenue over a period of 3 years, and my classes, it takes generally 35 to 40 classes for me to complete FR paper. Then as of now I have completed 10 classes. So don't you think I can measure my progress? What is the level of percentage I have completed the syllabus, right? 10 by 40, 25% syllabus completed, right? 15 by 40, this much percent syllabus completed. 20 by 40, 50% syllabus completed, right? 30 by 40, 75% syllabus completed. right? So I can measure the progress by two methods. One is input method, and another is output method. Okay, now what is the meaning of input method? Input method means what is the how will you measure the progress? You have to measure the progress in line with the efforts that are put in by the entity. How to measure the efforts put in by the entity? By way of cost, right? So you will measure cost incurred till date divided by total budgeted costs. That will give you the measure of progress. Output method will you can have survey method. Basically you have to measure that what is the benefit that the customer has got from the services done by me till date. What is the benefit that the customer has got? So we have to get the work certified by the okay. So survey method is also called as work certified method. Work certified method. Is it clear, guys? Percentage of work certified, very good. Is that clear to all? Now there is one activity in your BPP workbook I find that is very important, that is very good, that you can solve. But yes, since that was very lengthy, I am not taking that up in the class, but rather what I am taking up is a small question on this one, okay, so that I am able to convey my topic to you guys, okay, and you guys will understand the concept. So now there is a question number 77, question number 78, both on the same lines, okay. Let's solve both the questions and get a comfort over the topic, okay. Now so as you know that these questions has been taken from your BPP material, okay. BPP practice kit. Now question number 77. So what does the question say? Caraway entered into a contract on 1st January 20x5 to construct a factory for the seed company. The total contract price is $2.8 million. So let's write here contract price is $2.8 million. Now, which is expected to generate a profit for the Caraway company. Seed company obtains control of the factory as the asset is constructed. So condition number 1 got satisfied, or condition number 2 also got satisfied. Now the Caraway company has an enforceable right for the payment in respect of the construction complete till date, right? So condition number 3 also got satisfied. Contract states that the performance obligations are measured according to the certificates issued by the surveyor. What does it mean? Which method? Survey method, right? So we are following survey method. Right? Now, what does the question say again? As at 31st December 20x5, the contract was certified by the surveyor as 35% complete, okay? At year end, let me write here, at year end, that is 31st December x5, the project was complete. Percentage of completion, what was the percentage of completion? 35%. So what is the amount of revenue to be recognized? What is the amount of revenue to be recognized? What is the amount of revenue to be recognized? That is 2.8 million multiplied by 35%, that is equals to how much? 2.8 into 0.35 is 0.98. right? 0.98 million. Now, out of which 800 has been invoiced to the customer. Okay. Now it is 0.8 million is invoiced to the customer, meaning thereby let's pass the journal entry for this. See, we know that a revenue to be recognized is, that is 2 revenue is 980, right? But and trade receivable is how much? Because we have invoiced how much? 800,000, right? That is 800,000. Where will the balancing figure go? So till the time when we are recognizing the revenue, but we have not raised an invoice to the customer, it gets recognized as contract asset, right? It gets recognized as contract asset. Account debit, the amount is 1,80,000. Is that clear? Now what does the question ask for? Identify by selecting the correct options below whether a contract asset or a contract liability will be recognized as at 31st December 2005 and what carrying amount will be in the statement of financial position as at that date. So it will be contract asset 180,000. Contract asset 180,000. Is that clear, everyone? Question number 77 is clear to everyone? So this is the answer. So this is the answer. Okay, now let's solve one more question. 80, question number 80. Let's solve question number 80 as well. The company recognizes revenue on the basis of cost incurred to the date as a proportion of the total expected cost, means input method, right? Let's write here input method. Right, that is as a percentage of costs, as percentage of costs. Now see, this is the data given. Total contract revenue is this much, cost to date, okay, cost incurred is 48,000, estimated cost is 48,000. okay, now what is the percentage of completion then? Percentage of completion is 48,000, that is the cost incurred till date divided by total budgeted costs, that is 50%, right? Then what is the amount of revenue to be recognized? What is the amount of revenue to be recognized? What is the contract price? 120,000 multiplied by 50% is equals to 60,000 is the amount of revenue to be recognized, right? Now what is the question? What amount should be recognized as a contract asset? So this is the amount of revenue, out of which how much is invoiced? Tell me how much is invoiced? How much is invoiced to the customer? 50,400. So what is your contract asset? The remaining part, right? Your contract asset. What is the contract asset? What is your contract asset? It is 60,000 minus 50,400 is 9,600. 9,600 is the amount. See, this is the amount. 9,600 is the amount. Is that clear, everyone? Is that clear, everyone? Okay, fair enough. That's correct, Manav. Now, is that clear to all? Now, let us move on to the next topic, that is principal versus agent. Now, guys, we must understand that, okay, let me take up an example. All of you know this make my trip, percentage of completion. Saurabh, that's what I have explained here, percentage of completion. See, measure of progress is nothing but percentage of completion. The another name for this is MOP you can say, or POC you can say. Is that clear, Saurav? Or you want me to explain specific to this question? Question number 80, you tell me, what is your query, exact query, please tell me. Come on, Saurav, tell me what is your exact query. In this question, if it is in this question, then see the cost incurred to date is 48,000. Cost remaining to be incurred is 48,000. Cost remaining to be incurred is 48,000. So total budgeted cost is 48 plus 48, 96,000, not 48,000. Is it clear, guys? Is it clear now, Saurav? Cost already incurred is 48. Estimated cost is further estimated cost is 48. So 48 plus 48 is 96,000. Okay, let us move on to the next topic, that is principal versus agent. Now, guys, all of you know this companies called Make My Trip, Amazon, Myntra, all this company, all of you know, I think, right? Now, what happens? What happens? Do you think they Make My Trip, when you purchase a flight ticket from Make My Trip, it is the Make My Trip fulfills the obligation? No. Make My Trip has taken purchases. Make My Trip is just an agent of Indigo. If you are purchasing on the flight of Indigo, Make My Trip is just an agent of Indigo. Okay. If you are paying, let's suppose 6,000 to Indigo, Make My Trip, 5,000 Make My Trip retains with himself, and the remaining 5,500 is transferred on to the Indigo. Okay. Now the question comes up: how will Make My Trip recognize revenue, and how will Indigo recognize revenue? The answer to that, first we'll understand how to bifurcate that who is an agent and who is a principal. Three things. For that, three things. One, who bears the inventory risk? Who bears the inventory risk? Who determines the price? Who determines the price? And the third and the most important one, who has the primary responsibility of fulfilling the contract? Who has the primary responsibility of fulfilling the contract? Okay. Now let's talk about MMT. If the flight tickets of Indigo is not sold, who will bear the risk? Indigo or Make My Trip? It's the Indigo, right? The flight will run empty, then Indigo bears the risk, not Make My Trip. Who determines the price of the flight tickets? Indigo, not Make My Trip. Make My Trip just keeps his own share in that. That's all. Who has the primary responsibility of fulfilling the contract? It's the Indigo, not the Make My Trip. You are not flying in the flight of Make My Trip. You are flying in the flight of Indigo, right? It's the Indigo who fulfills the contract, right? It's not the Make My Trip. It's the Indigo. If you I don't know whether you have come across this situation or not. If you have to cancel the tickets at all, Make My Trip will not take a part in that. It will say just contact your airlines. Contact the airlines, right? So it's the airline which is the which has the prime responsibility of fulfilling the contract, right? So that will be so Indigo is the principal and the Make My Trip is the agent. So how does it differ? How does the revenue accounting differ? So the revenue accounting will be the principal recognizes gross amount as revenue. Okay, and the agent recognizes only the commission amount as revenue, meaning thereby in the example which I gave, Make My Trip can only recognize 500 as a revenue, and the Indigo can recognize 6,000 as a revenue. Indigo can recognize 6,000 as a revenue, and 5,000 as 500 as an expense, as commission expense, Okay, so the revenue that will be recognized by the Indigo is 6,000, and 500 will be recognized as an expense, and this 500 will be recognized as a revenue by the Make My Trip. Okay, this is, I'll write here, this is Indigo, this is Indigo, and this is a Make My Trip. Is that clear, guys? Is that clear, guys? Same thing happens when we purchase with Amazon, or same thing happens when you purchase with Myntra or any other this e-commerce portals. Okay, now coming on to the next topic, that is sale with a right to return. More or less the same, Manav, more or less the same. Okay, that's the reason why I'm not covering the consignment again here. Okay, so in the consignment, you have to understand that the control transfers when the consignee sells it to the end customer, and not when the consignor transfers to consignee. Okay, so you have to understand the control transfers when the consignor transfers to the consignee, and not the control transfers when the consignee and sells it to the end customer, and not when the consignor transfers it to the consignee. Okay, you have to be very careful in this one, in the consignment. Rest all is the same. Okay, now coming to the sale with a right to return. Guys, whenever we purchase anything from either shopping mall or from Amazon or from Myntra or anything, anywhere, don't you think we have a right to return? We have a 7 days return policy, right? We have a 7 days return policy whenever we purchase from Myntra, right? So what happens in that case? How will the company recognize revenue for that in that case? So in that case, what the company will do is, on the date of sale, okay, on the date of sale, the company will recognize revenue and cost of sales. But company knows that though I am recognizing this as a revenue and cost of sales, a portion of it will be returned back to us. A portion of it will be returned back to us, right? So company then estimates, okay, percentage returns. Company then estimates percentage returns, okay, and this percentage returns, company reverses revenue and cost of sales. But don't you think the company has already received the money? The company has already received the money, right? So now let me take up an example for that. Let's suppose the company has sold goods of $10,000, so it will recognize bank account debit to revenue $10,000. Now company estimates that see, this is 7 days return policy, 7-day return policy. Okay, so now while the company estimates that 15% of these goods will be returned, 15% will be returned. So company, what the company does, company reverses it. Company reverses the revenue. Here the company recognizes the cost as well. Let's suppose the cost is let's suppose 8,500. So company recognizes cost of sales account debit to inventory $8,500, 8,500. So now how will company treat it off? How will the company treat it off now? If the company estimates that 15% will be returned, how will the company treat it off? Let me take up red pen and write it off. So company will reverse the revenue. How? Revenue account debit to refund liability. Why? Because if it is returned, then I have to refund the money also, right? So the amount is 1500. Now similarly, the company will reverse the cost of sales also. So the company will recognize inventory. Again, inventory account debit to cost of sales. How much? 8500 multiplied by 15% is 1275. But now tell me, can the company recognize inventory? Inventory is still with the customer, right? So recognizing inventory will be wrong. So it will better it's open a temporary account, inventory with customer. Inventory with customer. Or it is also called as a right to return asset account debit. Okay, anything you can do. Now on this 7-day return policy, two things can happen. One, goods are returned or the goods are not returned. If the goods are returned, then what will we do? We'll refund a liability account debit to bank, will pay it off, and inventory account debit to inventory with customer account, right? If the goods are not returned, then in that case again we'll do a refund liability account debit, but to what? Tell me. Not to bank. If not returned, then I will again reverse this entry and recognize as a revenue, right? To revenue and cost of sales account debit to inventory with customer. This is how I have to recognize the entries. Is that clear, guys? Is that clear to all? Is that clear to all? Is that clear to all? Tell me please, confirm. Is that clear to all? Though this topic is not tested in this much detail in the exam, this topic is not tested in this much detail in the exam so far, okay? But you never know, anything can happen, right? So you have to be, because this is a very important topic, so I want you guys to be very much confident on this one, right? Is that clear, guys? Tell me, is that clear now? Okay, fair enough. Now coming to the last topic of revenue, warranties. That is warranties. Now, guys, we must understand that warranty can be of two types. Okay, which is basically distinct goods or services, or not a distinct good or services, not a distinct goods or services. Let me give an example. If you purchase a laptop and you get an inbuilt warranty, right? So that is not a distinct good or services, right? That is not a distinct, because that is attached with the laptop, right? So I'll write here inbuilt warranty. But when you purchase a laptop, you get an option to purchase an additional warranty, right? That is a distinct good or services, right? That is a distinct good or services, additional warranty. So now what the standard says? Standard says if the warranty is in the nature of distinct good or services, treat it as a separate performance obligation. Allocate the transaction price to it and recognize revenue as and when the performance obligations are satisfied. But if this is not a distinct good or services, then make a provision for this warranty. Make a provision for this warranty under IAS 37. Under IAS 37. Why? Because that's a you can say obligation of the entity, right? That's an obligation of the entity which the entity has to satisfy, right? Is that clear, guys? Is that clear, guys? The warranties are clear to everyone? Are warranties clear to everyone? Please confirm, guys. Is warranty clear to everyone now? Okay, fair enough. Now let us start the next topic, that is government grant. For government grant, I have made a simple chart so that this chart will make things very easy for you, I believe. Now, before I start government grant, tell me, guys, any queries anyone of you have in revenue before I start with the chapter called government grants? Tell me if you have any queries in inbuilt warranty and standard warranty are the same? Yes, Diksha. Basically, any warranty which is not a distinct, that the question will specify, or you have to understand the question. Okay, after reading the question, you have to understand it, whether it is a distinct or not distinct. If it is not distinct, you have to make a provision. If it is distinct, you have to treat it as a performance obligation. Okay, I just gave you an example of inbuilt warranty and additional warranty. That's all. Is that clear? Everything in revenue, guys? Is revenue clear to all? Or if you have any query, please let me know. Otherwise, I'll move on to the chapter called government grants. Okay, all clear? Okay, let us move on to the government grants, guys. Now, in this chapter, we have to understand how the grants will be recognized as an income in the. Majorly, we have to understand how the grant will be recognized as an income, or what will be the treatment if the grant has to be repaid back. What will be the treatment if the grant has to be repaid back? Okay, now okay, let's understand that. Guys, we must understand that we can recognize the grant in our books. Only if these two conditions get satisfied. What are the two conditions? That is whenever we get any grant from the government, there are certain conditions attached to that. Okay, so we can recognize the grant in our books only and only if we are certain that we will comply with the conditions. We will be able to satisfy the conditions that are attached to the grant. Okay, and second, if we satisfy the conditions, we will receive the grant. Okay, basically one from my end, one from the government's end. Okay, from my end is whatever conditions are imposed on me, I will satisfy that. Now, if I am satisfying that, government will give the grant also to me. Okay, so that's the two conditions. If these two conditions are satisfied, if both of these conditions are satisfied, then I can recognize the grant in my books, whether the grant is received or not received. Irrespective of that, I can record it in my books. If the grant is received, I will pass an entry called bank account debit to deferred grant. Okay, if the grant is not received, I will recognize an entry called grant receivable account debit to deferred grant. Why I have received written here asset, that I will discuss with you after 10 minutes. When I will discuss the subsequent treatment, I will explain that to you. Okay, but for so far, just treat it as a grant, deferred grant. Okay, now this grant that I am receiving, I have two options. Okay, or the grant can be of two types. One is related to income, or another is related to asset. Now, what is the meaning of grant related to asset or grant related to income? Let's suppose if the grant that is given to me is given for day-to-day operations, okay, then that's called a grant related to income. Or when it is given for purchasing any specific assets, that is called grant related to asset, and all other grants are grant related to income. Okay, if the grant that is given to us is related to related for purchase of any asset, that is called grant related to asset, and all other grants are called as grant related to income, that is either for day-to-day activities or for research or for any other activities. Okay, might be giving on the benefit to the customers, might be giving on the benefit to the normal citizens of the country, might be giving on the free services to the citizens of the country, right? For any other purpose, any purposes. Okay, now this is the initial accounting treatment. Subsequently, how will we recognize grant related to income? What will we do? As and when we will comply with the conditions, we will keep on recognizing this deferred grant as grant income in the P&L. We will keep on recognizing this grant as a income in the P&L in the ratio of the compliance cost. In the ratio of the compliance cost, let me write that. In ratio of compliance costs, that is the cost incurred divided by total cost, total budgeted cost to be incurred, in the ratio of compliance costs. Okay, you have to recognize that deferred grant as a grant income. Now what about grant related to assets? What about grant related to assets? Guys, there are two methods which are being followed. One is net method and one is a gross method. What happens in net method is, let's suppose I have received a grant of rupees of $1,500 for purchase of assets of $10,000. Okay, so what I'll do is I have two options. One, I will depreciate the $10,000 of the assets separately. I will recognize 1500 grant that I have received as grant income separately. Method number one, which is called as gross method. Method number two, called net method. In that, what I will do is 10,000 minus 1500 is 8500 is the value at which I will recognize the asset and I will depreciate it. Basically, your depreciation cost will reduce. So what happens in a net method and gross method? The impact in the P&L remains the same. But the presentation changes. In net method, we just show reduced depreciation cost. In gross method, we show grant income and the income side and depreciation cost in the expense side. Okay, let me show it with an example. Now, I have received a grant related to asset. Just a minute. I received a grant related to asset of $1,500 for purchase of machinery costing $10,000. Now, how will I do in net method and how will I do in gross method? Okay, in net method, first I will discuss gross method. Let's suppose the life of machinery is 2 years. 2 years is the life of machinery. Okay, so what I'll do in year 1 and year 2, grant income is 750 and depreciation expense is 5,000. Now what will happen in net method? Is I will say that my asset, the value of my asset is 10,000 minus 1500 is equals to 8,500. The journal entry being bank account debit to asset account 1500, right? Now, so what? How will it be show here? Year 1 and year 2. Year 1, year 2 will show depreciation expense as 8500 by 2 is 4250. That's all. See, the impact here also is 4250 only. The impact here also is 4250 only. But the presentation changes. Is that clear, everyone? Is it clear, everyone, guys? What happens in the net method? Now again, let's read this chart again. Initially, we will recognize the grant only if these two conditions are getting satisfied, right? So we will pass bank account debit to deferred grant, in all the cases for grant related to income. If it is grant related to assets and we are following gross method, then again we will pass bank account debit to deferred grant. If it is grant related to asset and we are following net method, then we will pass bank account debit to asset or grant receivable account debit to asset, right? So I'll write here we will use this one. We'll use just a minute. We'll use this one in the case of grant related to income plus grant related to assets gross method, and this one grant related to assets net method, right? Again, similarly, we'll use deferred grant when grant related to income or grant related to assets gross method, right? And this one in the case of grant related to assets net method. Is that clear, everyone? Now, if it is grant related to income, we will reverse deferred grant and will continue recognizing it as a grant income in the ratio of compliance costs. If it is grant related to assets, net method is used. We will just depreciate the net assets. If it is gross method, then we'll amortize. Then we'll reverse the deferred grant and we'll record the in the grant income. How? Over the life of the assets. Over the life of asset. Over the life of asset. Is that clear, guys? The initial and subsequent accounting for grant. Is it clear? The initial and subsequent accounting for grant. Very good. Now let us move on to the repayment of grant now. Refund of grant. See what happens, as I told that the grants has some conditions attached to it, right? And if you are not able to satisfy those conditions, the grant becomes refundable to the government. Now the question comes up, how will we do the accounting if the grant becomes refundable? So what will we do? We'll definitely need to pay it to the government, right? So to bank or a liability, we will at least record a liability. If it becomes refundable and we have not yet paid, it is a liability, right? So either bank or liability we have to record. Now see, first of all we will adjust from the deferred grant. If any excess has to be paid, let's suppose we have a deferred balance in the deferred grant of 5,000, but we have to repay an amount of 6,000. So then the differential 1,000 will be taken from the P&L account. Right? So the entry will become deferred grant account debit 5,000, P&L 1,000, to bank or to liability 6,000. That's all. Is that clear, guys? Is that clear, everyone? The grant related to income is clear. The repayment of grant related to income is clear, I believe. Now coming to grant related to assets. Again, same thing for gross method. See, if you are following gross method, same logic will apply. Okay, I'll write here. this one and this one same, this one and this one is same, right? We will not touch the assets any time, right? Now if we are following net method, then what will we do? The balance to which we have adjusted in the assets account, first we'll reverse that, and whatever we have charged depreciation will reverse that, and then we'll pay the bank or the liability, same thing, right? Whatever is the amount to be paid and whatever is adjusted from the asset account, whatever is the depreciation charged from that asset pertaining to that adjustment, we will adjust it from here and then we will record it off. Is that clear, everyone? Now let's solve a question on this one. Okay, let's solve a question on this one. There is one question 88 that you have to solve on revenue. I am solving question number 81 on government grant. Okay. Now, what does the question say? Broom company successfully receives a government grant of $1,500,000 on 1st July 20x5. On 1st July 20x5, the company has received a grant. Okay. Now, so definitely bank account will be debited. Bank account debit. How much? 15,000. Now, on 1st July, allowing it to purchase machinery which also cost 15,000. Okay, on 1st July 20x5, the machinery is depreciated on a straight line basis over 10-year useful life. A broom company has incurred the expenditure on the asset. The accountant has recognized the full amount of grant received as other income in the year. Okay, now, so company's policy is to account for all the grants as deferred income, meaning thereby gross method. The company follows gross method. So what will the company do on the date when the grant is received? Tell me, what is the entry that the company will pass on the date when the grant is received? On the date when the grant is received, the entry will be bank account debit to deferred grant. Right? But what the company has done, okay, the accountant has recognized the full amount of grant received as other income. Is that correct? No, that is wrong. Right? Now, what is the question asking for? Identify the adjustment required to correctly account for government grant as at 31st December 2005. Now see here what is happening. You have received the grant as on this date, 1st July x5. You are required to pass an entry on 31st December x5. Ideally on 1st July 2005, this entry was supposed to be passed, but the accountant passed this entry. Bank account debit to grant income, which was wrong. Ideally this was wrong. But now the question asks you, how will you correct the accounting treatment on this date? Tell me, during this period, what is the amount of deferred grant that will be recognized as an income? Grant income to be recognized. Tell me. Grant income to be recognized is 15,000 divided by 10 years is the life of the asset, multiplied by 0.5 year is already passed by, right? Meaning thereby, what is the amount? That is 75,000. The amount that is recognized as a grant income is 75,000. Till here, 75,000 was supposed to be recognized as a grant income. Naman, it's not 1,50,000, it's 75,000 for half of the year, right? For half of the year, 75,000. But they have recognized 15,000. So what is the amount of what is the amount of grant income to be reversed on 31st December x5, that is 1500,000 minus 75,000, which equals to 1425,000. Now what is the entry for that? Tell me, just let me see what are the accounts that are involved. Deferred income and other income. Okay, so what we'll do, we'll reverse the other income. Journal entry will be other income account debit, how much? 1425000 to deferred income. To deferred income 14,25,000. So this is the general entry required. Okay, so deferred income, so debit will be other income and credit will be deferred income. Amount will be 14,25,000, both the places. Is that clear, everyone? So this completes our topic on grant and revenue. Now we have to start with the taxation, then provision, then events occurring after the reporting date. So before that, we'll take a 10 minutes quick break. And then we'll start with the topic called taxation. Okay, but before we take a break, tell me guys, do you have any queries in the revenue or government grant? Any queries in revenue and government grant? Okay, fair enough. Let's take a break of 10 minutes and then we'll resume back. Okay, sharp at 6:32. Okay. Okay, let's resume, guys. Okay, so far we discussed about revenue, we discussed about government grants. Now we were starting with a new topic called taxation. Okay, okay. Now for tax, we must understand, guys, that tax expense that goes into P&L has two components. One is the current tax and another is a deferred tax, right? We are not going into the relevance of why deferred tax was brought into the picture, okay? But yes, let's understand what is the meaning of current tax and what is the meaning of deferred tax, and then we'll understand how to compute both of them, okay? Now, current tax is the tax payable on as per the Income Tax Act, as per the provisions of Income Tax Act, okay? And now tax payable as per the provisions of Income Tax Act. But what happens? This current tax is sometimes not in line with the accounting profits. Is not in line with the accounting profits. Okay, tax on the accounting profits. Okay, so that sometimes confuses the stakeholders. So that's why deferred tax concept is brought in. Okay, so now we have to calculate in this chapter. We have to calculate what is the tax expense that will go to P&L. So what we'll do is we'll understand the concepts, then we'll take up one question also which will help you in better clarity of the for understanding perspective. Okay, now what happens, you will understand that for a current tax, let's suppose for current tax, this is the financial year. Okay, let's suppose the financial year ended on 31st of December x2. Okay, now after the year end, we'll definitely make a provision of what is the amount of tax that will be payable, right? But now tell me, the provision that we make of the amount, is it a certain amount, or is it the amount that I'm making is it final? No, that is my estimate, that is the estimate that the entity makes, which is subject to review by the income tax department, right? Which is subject to review by the income tax department, right? So what happens, let's suppose I have made a provision of $100, I have made a provision of $100, right? Now and I closed this financial statements, I closed this year financial statements, it got audited and got closed. Now let's suppose next year end, 31st December x3, what happens, it is, let's suppose somewhere here the income tax department reviewed it and found that rather than 100 it should be $80 only, it should be $80 only. Now before I move on to that concept, tell me what is the entry that I'll pass here. When I'm making it as 100, I will record it as a tax expense account debit to provision for tax, amount is 100, right? That's what I will do for on this date. Now on this date, income tax department reviewed and told that okay, the provision should be only 80 and not 100. Provision should be only 80 and not 100. So what I will do on this date, provision for tax account debit to bank, I'll pay 80, but $20 is still $20 is still in the balance of provision for tax. It is still in the balance of provision for tax, right? Can I say this is a credit balance? Can I say this is a credit balance? Tell me, can I say this is a credit balance? Can I say this is a credit balance? Please confirm, guys. Please confirm me. Can I say this is a credit balance? Over provision, yes, Manav. Over provision in the previous year. Over provision in the previous year, right? But now let's suppose you have to make a provision in the current year also, right? Let's suppose the provision required for this year is $115. Tell me what is the amount of provision that you will make in the current year. 20 is already lying in the balance, right? So 115 is required. So what is the balance? What is the provision that you will make in the current year? What is the provision that you will make in the current year? Don't you think you will, in the current year, you will only make a provision of $95 because 20 is already lying in the balance, right? 20 is already lying in the balance, right? So that's what happens. So it says that credit balance means over provision in previous year. Over provision in previous year, adjust in current year. Right? Now debit balance means what? Under provision in previous year. Under provision in previous year, meaning thereby we have made a provision of 100 in the previous year, but when the income tax reviewed it, it told that no, it's not 100, it should be 105. So what happened? $5 was the under provision made in the previous year, right? So I will have to make a a 5 provision of $5 in the current year, right? So what I'll do? Increase in current year. Tell me yes or no. Tell me guys, yes or no. Is that clear everyone so far? Is that clear to everyone so far? Okay, now let's take up an example which will help you in better understanding of this thing. Okay, now example 1, credit balance in current tax credit balance of current tax that is $2.4 million, right? Tax provision for current year is $15 million. Tell me what is the P&L impact. Tell me what is the P&L impact. That is, what is the amount of provision that you will make in the current year? Amount of provision that you will make in the current year. Amount of provision you will make in current year. You will make in current year. $15 minus 2.4, very good. 15 minus 2.4 is 12.6. Very good everyone. So it is $12.6 million. Now let me take up one more question. Okay, if this if in the place of 2.4 million, if in place of 2.4 million it would have been debit balance, it would have been a debit balance of okay, 2.4 million, then the answer would be, tell me what would be the answer then in that case? What would be the answer in that case? If it is a debit balance of current tax, what should be the answer in that case? What should be the answer in that case? It's 15 plus 2.4, right? 17.4 million. Very good. Very good, Naman. Very good, Vidisha. Very good, Saksham. Okay, very good everyone. I think you have understood this concept of current tax. Now let us move on to deferred tax. Now okay, in deferred tax, guys, we have to understand that there are certain process involved. Okay, process is, first you have to calculate what is the carrying amount of the asset or liability. Then you will calculate what is the tax base of an asset or liability. I assume you know to calculate the carrying amount and the tax base. Please confirm in the chat box, guys. Please confirm in the chat box. Do you know how to calculate the carrying amount and tax base? If you are not aware of it, please let me know. I'll explain that as well. I believe you are already aware of how to calculate carrying amount and the tax base. Please tell me, are you clear on that point? How to calculate the carrying amount and the tax base? If not, then I'll start explaining that as well. Okay, just I'll quickly touch upon it. Okay, so carrying amount is the book value as per financial statements. Okay, Vidisha, no worries. Carrying amount is the book value as per financial statements. Right, now let's explain tax base. Let's understand tax base. Tax base of an asset. First, let's understand tax base of an asset. Okay, tax base of an asset, standard says two conditions. Two conditions. Condition number one, that from the asset, future economic benefits are probable. Future economic benefits are probable. Future economic benefits are probable. And condition number two is these benefits are taxable. These benefits are taxable. If these two conditions are satisfied, then in that case, tax base of an asset is equals to future deductions available from the asset in the tax books. Future deductions in tax books. Now let me take up an example. Okay, or let me write the first one. Or else if any of these conditions are not satisfied, then tax base is equals to carrying amount as per FS. Let me give you two examples now. Plant and machinery. Okay, from plant and machinery, by using it, don't you think we will get future economic benefits, right? By using that, we'll get future economic benefits, right? Because when we use the future plant and machinery, we generate outputs. These outputs we sell in the market and we generate revenue. These revenue are taxable. So when we talk about plant and machinery, the future economic benefits are there and those benefits are also taxable. Okay, so in that case, I can say for plant and machinery, the tax base will be equals to future deductions in the tax books. And now for a plant and machinery, what is the future deductions? The written down value, because the written down value of the plant and machinery will be the deduction in the future as depreciation expense in the tax books. Right? Do you agree with me? For plant and machinery, what is the future deductions? The future depreciation. And what is future depreciation today called as? Written down value. The written down value of the plant and machinery is nothing but the future deductions of the asset. Do you agree with me? Jisan, Saksham, Vidisha, please tell me, do you agree with me? Future deductions of plant and machinery is nothing but the written down value of the plant and machinery. Please tell me, guys, is it clear? Right, now let's take up another example. Okay, so we have taken one example. Number one is plant and machinery. Right, condition number one and condition number two. Both gets satisfied, right, and hence tax base is equals to future deductions is equals to what? Written down value is equals to written down value. Now let me take up example number two. Debtors. For debtors, definitely there are future economic benefits, right? Because we will recover the debtors. So condition number one gets satisfied. But tell me, the debtors which we will recover, are those taxable or are they already taxed in the past? Tell me, debtors which are recoverable, are they taxable or are they already taxed in the past? Are they taxable or are they already taxed in the past? Debtors on recovery, are they taxable? No, they are already taxed in the past, right? So condition number 2 does not get satisfied, right? So in that case, our tax base is equals to your carrying amount as per FS. As per your carrying amount as per your FS. Is that clear, guys? Is that clear, guys? Vidisha, Saksham, Jishan, Diksha, Manav, Naman. Is that clear, everyone? The meaning of tax base of an asset? The meaning of tax base of an asset? Now, let's understand the tax base of a liability. Let's understand the tax base of a liability. Okay, so tax base of a liability is very simple. That is equals to carrying amount minus future deductions. That's all. That's all. No conditions, nothing. Simply carrying amount minus future deductions. Now let me take up certain examples. Certain examples. Let me take up certain examples. Provision for example number 1 is provision for bad and doubtful debts. Bad and doubtful debts. That is a liability, right? Now, what is the tax base of that? Tax base is equals to carrying amount is, let's suppose, $100. Now, tell me, what is future deductions for provision for bad and doubtful debts? So now, what happens for bad and doubtful debts, for provision for bad and doubtful debts, it is not allowed as an expense in the tax books. It is not allowed as an expense in the tax books. It is allowed as an expense in tax books when it is actually become bad debts. When it actually become bad debts. So tell me now, let's suppose in the current year, in my books that I have recognized provision for bad and doubtful debts of $100. Will I recognize it as an expense in the tax books? No, I will not recognize. Rather, I will recognize it in the future when it actually becomes bad debts. So, don't you think this provision for bad and doubtful debts will be recognized in the tax books in the future? So, that's a future deduction, right? So, the whole amount will be recognized as an expense in the tax books in the future, right? So, that's why it is a future deduction. So, tax base becomes nil. Tax base becomes nil. Tax base becomes nil. Is that clear, guys? Is that clear, guys? Now, let me take up example number 2. Creditors. Tax base is equals to, let's suppose the carrying amount is $100. Tell me, with respect to creditors, will we get any deduction in the tax books in the future? Will we get any future deductions in the tax books? With respect to creditors, will we get any, will we record any future tax expense? Will we record any future tax expense? No. No. Nil minus nil is equals to 100. 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 Is that clear, guys? Is that clear? The tax base of a liability is clear, I hope. Right? Now, coming on to the steps for recording the deferred tax liability, but before that, let me just give one clear line here so that you guys don't get confused. Okay, now steps. Calculate temporary difference. And what is the meaning of temporary difference? Carrying amount minus tax base. Carrying amount minus tax base. See, understand, guys, the deferred tax was brought into the picture because there is a timing difference. There are timing differences. Some expenses is recognized in the FS books, in current year, but are not recognized as an expense in the tax books in the current year, but might be recognized in the tax books in the next year, or next to next year, or next to next to next year. right? So, but they will definitely be recognized in both the books, but there is a timing difference of recognition. There's a timing difference of recognition, right? There's a timing difference of recognition. So now it's there, it's called a timing difference, and we have to record as a deferred tax on that, right? So first we'll calculate what is the temporary difference, that is carrying amount minus tax base. Carrying amount minus tax base, whether it is for an asset or for a liability, for asset or for a liability. Now once I have calculated what is the temporary difference, it is then I will classify the temporary difference. I will classify the temporary difference whether it is a taxable temporary difference or deductible temporary difference. Now what is the meaning of taxable and deductible temporary difference? Meaning is, if this temporary difference in the future will increase the tax liability, so I'll write here, if it increases the future tax liability increases, that's called taxable temporary difference. If it decreases, that's called deductible temporary difference. That's called deductible temporary difference. Okay. If it increases the tax liability, it's called taxable temporary difference. Taxable temporary difference. If it decreases the taxable if it decreases the future tax liability, it is called deductible temporary difference. Right. Now taxable temporary difference means increases the future tax liability. So don't you think should be recognized as a deferred tax liability? Right? If some event increases my future liability, that is a liability for us, right? If some event reduces my liability, that's an asset for us, right? So deductible temporary difference decreases the future tax liability, and hence that's a deferred tax asset for us, right? So taxable temporary difference multiplied by the tax rate comes to deferred tax liability. Deductible temporary difference multiplied by the tax rate comes to deferred tax asset. Now the movement of deferred tax liability during the year or the movement of deferred tax asset during the year is your P&L impact. It might be deferred tax charge, that is deferred tax expense, or it might be deferred tax credit, that is deferred tax income. Deferred tax charge or deferred tax credit, it can be both. Is that clear, guys, to all of you? Tell me, guys, is that clear to all of you? Is deferred tax clear to all of you? Jishan, Priyanka, Saksham, Manav, Diksha, Naman, Vidisha, Naman, Rajat. Yes, okay. Now what we'll do is we'll take up one question, but before we take up one question, I'll just tell you one specific thing related to deferred tax, and then we'll take up one question. Our standard says, point number 4, our standard says that if the temporary difference is arising for a P&L item, the deferred tax will also go to P&L. Deferred tax impact will be in P&L. Let's suppose the temporary difference arises from depreciation, that goes to P&L. So the deferred tax impact will also go to P&L. If temporary difference arises from OCI, that is revaluation of an asset, then the deferred tax impact will also go to OCI. Okay, now let's take up a question, and this question covers all the topics which we have discussed in the class today. Okay, relating to taxation. Okay, let's discuss this topic. Yes, I will explain that, Manav. I've taken that up in the question. Question number 135. Okay. Let's see this question. Unington's trial balance shows a debit balance. So let's first discuss current tax and make it aside, because that is easy one, right? So I'm writing here two things. One is current tax. We have to discuss two things. One is current tax and one is deferred tax. Now let's discuss. Ewington's trial balance shows a debit balance. Okay, now let's write here debit balance of $2.1 million, $2.1 million plus provision required for current year, is tax charge for the current year is $16.2 million, $16.2 million. Okay, now tell me what is the current tax. What is the current tax? Debit balance means what? Debit balance means what? Under provision in the current previous year or over provision in the previous year? Under provision in previous year or over provision in previous year? Debit balance means what? Tell me, debit balance means what? Under provision in previous year or over provision in previous year? Tell me guys. Under provision in previous year, right? Under provision in previous year. Very good, Diksha. Very good, Manav. Now, so what is the amount? Under provision means we have to make a current provision in the current year. So 2.1 plus 16.2 is 18.3 million. 18.3 million is the current tax amount. Now let's come to deferred tax. Let's come to deferred tax. Listen to me very properly, guys, for deferred tax. I will not be able to explain it again. Listen to me very properly, okay? Now, credit balance of 5.4 million brought forward on deferred tax means what? Opening balance of deferred tax liability of 5.4 million. Tell me, clear or not till here? Clear or not till here? Tell me. Opening balance of deferred tax liability of 5.4 million. See the question. Credit balance of 5.4 million brought forward on deferred tax. Credit balance of 5.4 million brought forward on deferred tax. That is deferred tax liability of 5.4 million. Priyanka, how come under provision you are talking about? Okay, you are telling from the previous question. Okay, no worries. Okay. Now 5.4 million brought forward on deferred tax is the deferred tax liability opening balance 5.4 billion. Deferred tax liability opening balance 5.4 million. Now, what does the question say? The question says during the year, carrying amount of net assets exceeded the tax base by 13 million. Now, what does carrying amount represents? What does the carrying amount represents? Carrying amount represents future economic benefits. What does a tax base represents? Future deductions. Now, if future economic benefits are greater than future deductions, tell me this temporary difference will be taxable or deductible? Means in the future the benefits are greater than deductions. If benefits are greater than deductions, that will increase your tax liability. Right? If it increases your tax liability, it will be taxable temporary difference. Right? If it's taxable temporary difference, then multiplied by rate comes to what? It will be deferred tax liability of how much? What is the rate? 30%. Rate 30% is 3.9. Meaning thereby your closing deferred tax liability, just a minute. your closing deferred tax liability, your closing deferred tax liability is 3.9 million. Please tell me, is it clear so far or not? It is, then I will start the point of revaluation. Please tell me, is it clear so far? Is it clear so far? Is it clear so far? Everyone, is it clear so far? Okay, fair enough. Now, what does the question say? This 13 million includes 3 million revaluation surplus. 3 million of revaluation surplus, the impact of which will go to OCI. Now, revaluation surplus means benefits. Benefits means deferred tax charge. Benefits means deferred tax charge. So it says that here plus deferred tax charge, which will go to OCI. How much? 3 million, right? 3 million multiplied 30% is 0.9 million. Is 0.9 million. Now you have to find what is the P&L impact. That's your question. You have to find what is your P&L impact. That's your question. You have to find what is your P&L impact. So the answer to that is very simple. You know what? Your answer to that is very simple. How? See, your P&L impact is opening, that is 5.4, plus charge during the year 0.9 minus closing 3.9 plus closing 3.9. Tell me what is the balance coming up. Tell me what is the balance coming up. That is 2.4, but this is deferred tax credit. This is deferred tax credit. This is deferred tax credit. Or if you have to do it other way around, tell me what was the opening deferred tax? What was the opening deferred tax liability? 5.4. What was the closing deferred tax liability? 3.9. What is the movement? Movement is 1.5. Movement is 1.5, right? Movement is 1.5 deferred tax credit. Movement is 1.5 deferred tax credit, right? Out of this, you are telling what 0.9 is OCI, deferred tax charge. So what is the impact that should go to P&L to make this happen? Tell me. So don't you think that should be 2.4 deferred tax credit, right? So this is plus, this is minus, this is plus, this is minus, right? So hence it will come plus. How exactly? Let's see this one. 0.9 minus 2.4 comes to 1.5, comes to 1.5. So that is how it should be recorded for. That is how it should be recorded for. Now what is the P&L impact of deferred tax? What is the P&L impact for deferred tax? 2.4 million. 2.4 million, right? 2.4 million. So what is the net P&L impact? Net tax expense. Net tax expense that will be recorded for in P&L is how much? Tell me. That is 18.3 minus 2.4. 18.3 for current tax minus 2.4 deferred tax credit, that is equals to how much? 18.3 minus 2.4, that is 15.9 million dollars. Tell me guys, is that clear to all? Anyone on to whom this is not clear? Anyone to whom this is not clear? I am waiting here for 2 minutes. I'm waiting here for 2 minutes, guys. Please tell me if it is clear or not, everyone. Naman, sir, if revaluation is not included in deferred tax, then revaluation impact will be ignored. If revaluation is not included in deferred tax, then revaluation impact will be ignored. Naman, let's understand this, Naman. If question says that deferred tax impact is separate, this 3 million is separate of 13 million, okay, then you have to again first merge 13 plus 3, 16 and find what is the closing deferred tax liability, and then do this, okay. Because for revaluation also we have to recognize deferred tax liability. Naman, is your query clear now? Is your query clear now? But always remember, for revaluation we have to transfer to OCI, not in P&L, right? Revaluation, whenever there is a benefit, it will attract deferred tax charge. Whenever there is a benefit, it will attract deferred tax charge. Revaluation surplus is a benefit that I have got, right? Future economic benefits is higher than future deductions, it will lead to future tax liability. It will become taxable temporary difference. I hope it is clear, guys. I hope it is clear to all. Very good. Now, coming back to our topic again. Now, coming to the topic 4, that is provisions. Okay. Now, guys, provision I will be discussing very generic because there are a lot of examples given in your book which you can read and understand though, but yes, I will explain you the general logic behind everything. Okay, I will explain you the general logic behind everything. Okay, that if there is a present obligation, if there is an obligation, first let's understand what is the meaning of obligation. Obligation means you are bound to you are bound. Okay, now if there is a present obligation, means the amount will be paid, that is certain. Amount that will be paid is certain, and the amount is also certain. Okay, the outflow is certain, amount of outflow is also certain. In that case, you will recognize a liability. Right? Amount will be paid is certain, but what amount will be paid is not certain. Let me give you an example. Electricity bill, right? For the month of March, we recognize the provision. Why? Because the bill will come in the month of April. So we know that that we have to pay definitely, but what amount will come, we don't know. So we estimate the amount and we record it as a provision. Right? Because the outflow is certain, amount is not certain. So amount we have estimated. So that is called a provision. Now, probable obligation means outflow is not certain. But the chances of outflow are very high, that is greater than 50%. The outflow of the chances of outflow are greater than 50%. Okay, so this present obligation means probability greater than 95%. Probable means probability greater than 50%. Okay, if the amount is certain or the amount is estimated, in both the cases it will be provision. Why? Because the happening of the event is not certain, it is probable. If the happening of the event is certain and the amount is also certain, it is a liability. If both happening and the amount is certain, it is a liability. If either of them is not certain, it is a provision. But if the probability is less than 50, then in that case, whether the amount is certain or the amount is not certain, we will record it as a contingent liability. Not record, we disclose it as a contingent liability. Is that clear, everyone? We disclose it as contingent liability. Remote obligation means probability is less than 5%. In that case, we ignore it off. Is that clear, guys? Is that clear, guys? In what case we recognize provision? Is it clear to all of you? Is it clear to all of you? The meaning of provision is clear to all of you? Okay, fair enough. Now let's see the inflow also, the right to inflow. There is a present right to inflow. There is a present right to inflow. Okay, we will record it as an asset. The right to inflow is probable. The percentage remains the same again. Percentage probability greater than 95%. Probability greater than 50%. In that case, we record it as a contingent asset. Contingent asset, right? And now probability less than greater than 50%, probability less than 50%, or probability less than 5%. In both the cases, our standard says we will ignore it off. We'll ignore it off. We'll ignore it off. We will not record either the asset or the contingent asset, or disclose it as a contingent asset. Okay, we'll totally ignore it off. We'll totally ignore it off. Is that clear, guys? Is it clear to all of you? Okay, let us do one thing. Let us solve certain questions, okay, for provisions, so that it will give you us better clarity. Question number 118. Now it says that select whether a provision is required or is not required in the financial statements of the following companies. Okay, so there are 4 case studies given. You have to understand and for each of them and say whether a provision is required or not required. Okay, so it says Ashton Company has a company policy of cleaning up any environmental contamination caused by its operations, even though it is not legally obliged to do so. See, we need to understand that even there is no legal obligation, but there can be a constructive obligation, right? The obligation can be constructive, right? The obligation can be constructive. The obligation can be constructive, right? So now, let me write here. The obligation can be. It can be legal obligation, it can be contractual obligation, or it can be constructive obligation. Or it can be constructive obligation, right? It can be constructive obligation as well, right? Now, in all the 3 cases, we have to record it as a provision. In this case, it is not a legal obligation, but it is a company's policy to clean up, means constructive obligation. I have taken up this obligation on myself, so I will record the provision for this, right? Now, Broom Company has a fixed price contract to supply widgets to Eldington Company. Broom Company has calculated that it will cost more to manufacture the widgets than budgeted, which is more than the revenue agreed from the Eldington Company. Tell me what will happen. Will we record provision? So this becomes an onerous contract. This becomes an onerous contract, right? Tell me, guys. Naman, Akshat, Jishan, Saksham, Vidisha, Manav. This becomes an onerous contract, right? And hence a provision will be required. Onerous contract and a provision will be required in this case, because in this contract, we have entered into this contract and we have to perform this contract, but the costs are greater than the revenues, right? So it's an onerous contract. It's an onerous contract, and we have to recognize a provision for the onerous contract. Now, third one, Coles Hill is a closing down a division. Board has prepared detailed course plans which have not been communicated to the customers and the employees. Guys, we need to understand that for restructuring provision, we can recognize a provision. We can recognize a provision for restructuring costs if the plan is duly approved and communicated to all the concerned employees, right? Concerned employees or the affected employees. In that case, we can recognize a provision. Other than that, we cannot recognize a provision. Other than that, we cannot recognize a provision. Right? So in this case, we will not recognize a provision. Fourth point, Dudley company has acquired a machine which requires staff training cost, staff to be retrained on its safe operation. The staff training will occur in the next financial period. Have I entered into an obligation as of now? What is the meaning of provision? Present obligation arising out of past events, right? Present obligation arising out of past events or probable obligation arising out of past events. Is it a past event or a future event? Tell me, is it a past event or a future event? It's a future event. Will I recognize a provision for a future event now? No, I will not recognize for a future event, right? Provision is a present or probable obligation arising out of past events, not future events, right? So this is a future event. So hence we will not recognize a provision for that. No provision required, right? Coming to next point, 119. Fluid company undertakes drilling activities and has widely publicized environmental policy stating that okay, again it's an environmental policy. Company policy means constructive obligation, that it will incur cost to restore land to its original condition once drilling activities have been completed. Okay, now what does it say? Question number 119. It says that it is doing drilling activities here. Okay, drilling activities here. This asset will have a life of 5 years. Okay, at the end of the life, this place will be restored. This place will be restored. Now, if the company has to restore this place, definitely it will incur certain cost, right? Definitely it will incur certain cost, right? For which a provision will be required as of here. A provision is required as of here. That is called by the name provision for dismantling cost, right? Dismantling or removal cost, right? Which we capitalize with the asset also. Now, so what is the cost it will incur? 3 million here. Here 3 million will be incurred, $3 million will be incurred. Now, what is the present value? At the rate of 0.713. So what is the present value? It is 3 multiplied by 0.713 is equals to 2.139 million. What is the question asking for? This has been entered on 1st July 2008. 1st July X8. What is the question asking? At what amount will the provision for restoration costs be measured in Fluid Company statement of financial position as at 31st December 2008? As at 31st December X8. This amount of 2.139 is on 1st July 2008, right? So you have to move it, you have to unwind it and bring it to 31st December. How will you bring it? Charge finance cost plus finance cost, how much? So 2.139 multiplied by, what is the rate of interest? 7%. Multiplied by 6 by 12 is equals to how much? Is 0.074865. So what is the amount here? Provision on 31st December X8 is equals to 2.139 plus this one is equals to 2.3865. What is the option given? 2.21. See, this is the answer. Fourth number is the answer. Is that clear, guys? All of you? Is that clear, all of you? Now, let's come to question number 120. Is it clear, guys? 2.214. Very good, Naman. Very good, everyone. Okay, let's come to question number 120. Identify whether the following statements are true or false in accordance with IS 37 provisions, contingent liabilities and contingent assets. Provisions should be made for both constructive and legal obligations. Right now we discussed, right? We'll make it for both constructive, legal and contractual obligation, all three, right? So true. First point is true. Discounting may be used when estimating the amount of provision. Right now we discounted it for, right? So true. A restructuring provision might include the cost of retraining or relocating continuing staff. Will we tell me, will we include this one? Continuing staff, retraining or relocating continuing staff? No, it will have the provision for the outgoing staff. That is the cost of restructuring. Continuing staff are not part of restructuring, right? The staff which will go off as part of restructuring, we have to include that as a provision only, and also that if only when that is communicated to that parties. Right now, a restructuring may be so the answer for this one is false. So it is true, true, false. Now, a restructuring provision may only be made when a company has a detailed plan for the restructuring and has communicated to interested parties a firm intention to carry it out. So answer to that is true. Answer to that is true. Tell me guys, is that clear? Is that clear to everyone? Is that clear to everyone? Is that clear to everyone? Okay. Now one more question. Okay. Hopewell company sells a line of goods for under a 6 months warranty. Okay. Now 123. Hopewell company sells a line of goods under 6 months warranty. Any defect arising during that period is free of charge. Okay. Hopewell company has calculated that if all the goods sold in the last 6 months of the year required repairs. Okay. So it says that there are three situations. Goods might require repairs. Goods might not require repairs but require replacements, major repairs. It might require replacement. And no defects. And no defects. Okay. Now, so if says that if it requires repairs, it will cost $2 million. If it says if it requires replacement, it will cost $6 million. If it requires replacement, it will cost $6 million. Okay. If it requires no defects, then $0 million. Now, but what is the probability? See, the normal pattern is that 80% of the goods sold are fault free. So no defects means 80% of this. 15% will require repairs. 15% will require repairs, and the 5% will have to be replaced. 5% will have to be replaced. So let's multiply and find it out. What is the amount of provision required? So 2 multiplied by 15% is 0.3 million. Now 6 multiplied by 5% is again 0.3 million. This is nil, so it is $0.6 million. $0.6 million. So $0.6 million again, right? So answer to that is 1, $0.6 million. Is that clear, guys? Everyone? Is that clear, everyone? Is question number 123 is clear to everyone? Akshit, not 0.3, it's 0.6, totally 0.6. Right? Now, coming on to the last topic for the day. That is events after the reporting date. Events after the reporting date. That's a very small topic, and let's discuss it off and wrap it up. Guys, what it says that events after the reporting date but before the financial statements are signed for are due for authorization. Okay, FS are authorized. We are talking about the events occurring in this period. Okay, whether these events are adjusting or not adjusting, okay, in the financial statements. Now, basically it says that if any event occurs in this period, if any events occur in this period, the conditions for which already existed on this date, the condition for which already existed on the reporting date, then yes, that is adjusting. That is adjusting. Otherwise, it is not adjusting. But still, it says there is an exception on that rule also. There is an exception. If let's suppose if the condition does not exist on the reporting date, but the event is such a significant event that it impacts the going concern matters, then in that case it will be an adjusting event. Is that clear, guys? Is that clear? Okay. If any events occur between after the reporting date but before the FS are authorized, those events, if the conditions existed on the reporting date, then they are adjusting event. Otherwise, they are not adjusting event. Let me give an example. Debtors existed here, right? The debtor became insolvent here. That are adjusting event. Let's suppose one of my truck met an accident on this date. After my reporting date, one of my truck met an accident. That is not adjusting event, because the condition didn't exist in the reporting date, right? My factory caught fire. That is not an adjusting event. But my factory caught fire and it impacted my going concern. That is an adjusting event. Okay. So that's all about your events occurring after the reporting date. Let's solve one question on that. 124. Okay. Now, which two of the following events which occur after the reporting date of the company but before the financial statements are authorized for issue are classified as adjusting events in accordance with IAS 10? Events after the reporting period. A change in the tax rate announced after the reporting date but affecting the current tax liability. Tell me, did the condition existed on reporting date? No. Condition existed on reporting date? No. Condition existed on reporting date? No. So will this be adjusted? No. Discovery of fraud which had occurred during the year. Now, fraud has happened in this period itself, but I got to know about the fraud here. See, condition existed on reporting date, but it just got confirmed after the reporting date. So it will be adjusted for. It will be an adjusting event. Right? Now, the determination of the sale proceeds of an item of plant sold before the year end, right? So I have sold the plant before the year end, but the sale price I have determined after the year end. So will it be an adjusting event? Yes, because the condition existed on the reporting date that the sale has already happened before the reporting date. So it will be an adjusting event. The destruction of factory by fire is not an adjusting event till the time it doesn't impact my going concern. Is that clear, everyone? Guys? All of you? Okay, fair enough. Anyone having any queries so far? I can take up any queries now for the topics discussed yesterday and today. I can take up topics, queries, guys. I can take up queries. Any queries anyone has? Any queries? Guidance on answers on exam, right? Okay. Guys, first point, read the question properly, guys. Read the question properly. solely just now by reading the question you can avoid a lot of mistakes. Okay, read the question properly. Second point. Now the question might ask you, let's suppose simple this one is written, okay, then you have to write your answer in absolute figures. If the question says this and right here millions, or it says thousands, then write your answer in millions or thousands. Don't write your answer in absolute figures in that case. Don't write your answer in absolute figures in that case. Right, write your answer in millions or thousands. If the question says write in 2 decimals, then write your answer in 2 decimals only. Write your answer in 2 decimals only. Just what I am trying to say here is be mindful when you are reading the question. Just by avoiding these small mistakes, you can increase as good as 10 to 15 mark of yours. I can guarantee that to you. A student generally loses marks in these type of mistakes also. So please don't make mistake in these type of mistakes. Okay, please don't make these mistakes. Okay, is that clear everyone? Is that clear everyone? Vidisha has a query of question number 115. Okay, let me take it up, guys. Just let me get my book. 115. This is from which chapter, guys? It seems to be lease. It seems to be lease. Okay, let me take it up. No worries. Question number 115. Okay, JSM company entered into an agreement for right to use an item of plant for a period of 10 years on 1st April 2080. Agreement required payments of 15,000 to be made. Vidisha, provisions, I think you are following old material, that's why you are telling me this provisions. In my book it is on leases. What you can do, guys, your questions you can send in the group. I will see to it and answer it. Okay, because you might be having different book. I am having different book, you might be having different book. Okay, so what you can do is after the class you can send your questions in the group and I will resolve it off there. Okay, any queries other than the questions? Any queries other than the questions? Guys, questions please send in the group. I'll after the class I will see the questions and I'll resolve it off. Okay, any other queries? No. Okay, so that's all for the day, guys. That's all for the day. I hope this session would have been helpful to you guys. Thank you all. Bye bye, guys.